must begin by thanking the Bar Association for giving me this opportunity of speaking on this subject. And tax really is a subject very, very close to my heart. And this bar and the members of the bar are equally close to my heart for the reason that I started my career here. My baby steps in law, so to speak, were taken at this bar. And I've learned from many seniors who are today, as I see, participating here. So as I speak, I'm sure there'll be errors, and therefore, even before I begin, I must say I must request all of you to pardon all the errors and glitches that may come through in whatever I speak. I'm sure there will be a lot of questions, and I'll be happy to take the questions at the end of the talk. To begin with, let me, I'm sure, through the weeks following the lockdown, there have been various speakers, and I must say far more erudite than me, who have spoken on the law on GST. I'm here to actually speak on a very small yet a very, very significant provision which relates to anti-profiteering measure. But before I do that, let me very briefly touch upon the reasons for which the law was introduced. And when I'm saying the law, I'm talking about the law on GST that was introduced and the objective that it sought to achieve. Now, we all understand that, GST was introduced for the various benefits that it brings. And amongst others, the most important are, one, that it gives a unified tax structure as against a slew of various taxes. So you can think of the excise duty, the octroi, the entry tax, and the like. Second was that the unified or a single tax rate within that structure. Now, unfortunately, given our political sphere, we've not been able to get one unified tax rate, and we suffer. I must say that we continue to suffer from various tax rates. And the third is a seamless flow of credit, which is to ensure that the cascading effect of tax is removed, which finally obviously leads to lessening of a tax burden on the final consumer. The obvious idea was to formalize an informal economy, reduce or negate credit leakage, rationalize the tax rate and structure. It was also assumed that, and I must say not without reason, that the ultimate benefit of introduction of GST would be that it will help lessen the tax burden for the final consumer. The experience of various countries who have introduced GST is that it has helped in achieving exactly the elements that I'm speaking of. And therefore, the expectation of the Indian legislature was very, very real. It is a different story that a fractured political theater spread between the center and the state did not allow for a smooth implementation of the ideal structure. That apart, as we will shortly see as we go forward, the flawed drafting, interpretation, and implementation of this law has not helped the cause of this otherwise robust system of taxation. With the introduction of GST, it ensured that 11 other levies, and as I mentioned, the excise, service tax, VAT, octroi, entry tax, etc. Now all of it came under one umbrella, resulting in reduction in different forms of taxes collapsing in a unified tax structure. To an extent, therefore, it has helped in rationalizing the tax rates. Also, as credit flow has smoothened, the cascading effect of tax was removed, and it also yielded in many cases higher tax returns, credit returns. Now, with a view to prevent companies from taking undue benefit of either the reduced tax rate or the higher tax credit available under the GST regime, and to ensure that the benefit arising therefrom is effectively passed on to the final consumer, anti-profiteering provisions were incorporated under the GST laws. Now, in this connection, you had the National Anti-Profiteering Authority, which was set up and empowered purportedly, and I'll say why, I'll come to the purported part of it a little later, but, purportedly to check unfair profiteering activities by registered suppliers. If you were to see the e-flyer, which was issued by the NAA, on the NAA by the CBI EC. In this regard, it is quite instructive as to the objective for assuring in the anti-profiteering provisions. It notes that the experience of many countries which introduced GST was that upon its introduction, there was a marked increase in inflation and the prices of the commodities. Now, according to the e-flyer, that happened because, and this is in spite of the availability of the tax credit right from the production stage to the final consumption stage. Thus, the experience was in a way to the contrary. That is what the e-flyer is saying. And it was obviously because the supplier was not passing on the benefit to the consumer and thereby indulging in illegal profiteering. To me, this rationale itself is flawed to begin with. The thinking seems to be that reduction in tax rate and stroke or the availability of higher credit in a way has a linear correlation to the prices of goods. In a manner, it presumes that the supplier has nothing else to consider except the tax rate and tax credit while deciding the price of its supplies. In this context, to me, it is essential to understand that there is a difference and a key difference between two terms, profit and profiteering. And to me, what it seems is that the manner in which the provision maybe is couched or the manner in which the interpretation is being led, the emphasis seems to be to stop companies from making a profit. And this is, to, again, a very skewed thinking of many developing nations. I will not single out India and say that our either our political theater or our culture really prohibits or abhors profit making. But at the same time, if you look at many developed countries, you'll find that there is a huge difference between the so-called have and the have-nots. And really, a person who's making a profit is in a manner at some point in time looked at as a pariah rather than someone who's actually bringing food to the table. And that thinking really needs to change. So therefore, as I said, that the key difference here really is between the terms making a profit and profiteering. Profit, which is one of the possible derivatives of a commercial activity, to my mind, is essentially the difference between expenses incurred and the revenue generated by the enterprise. And that is, this is something which is a simple accounting exercise. On the other hand, determination of profiteering vis-a-vis a product is far more complex exercise that requires a cost analysis. Again, this is something that I believe that, a complete cost analysis of each line of supply, along with various other elements of doing business that impacts it, to determine the benefit, if any, which is accrued on account of reduced tax rate or an enhanced tax credit. Accordingly, the supplier needs to reduce his prices to ensure that the benefit arisen on account of reduced tax or an enhanced credit is passed on to his customers. This willful action of not passing on the benefit would actually mean that the supplier in a way has profiteered. But experience in India demonstrates an utter lack of this understanding of an important difference between profit and profiteering. In introducing GST, the idea could never have been to mar the business's ability to generate profit, which is, as we all understand, the lifeblood of a business. Profit, as I said, is the function of many things and is completely reliant on the vagaries of market forces. It is the department which believes otherwise and wants to control the extent of profit that business make. Determination of price of a product and the profit on it is entirely dependent on the commercial acumen of businessmen, which in turn, as I said, is guided by market forces at play. Clearly, to me, the government and its functionaries ought not to have a hand in either. But that is exactly what the department has been doing. And the experience, if you were to appear before the NAA, you will have a very sad experience, so to speak. And if you were to look at the orders of the NAA, to my mind, almost 99.9% of these orders uphold a allegation of a mere allegation of profiteering. So what the department has been doing is exactly against and contrary to the principles possibly, being sought to be brought in by the provision, and albeit what they are doing and is under the garb of the exercise of their powers uh, under the so-called anti-profiteering laws. To me, it is as if, businesses survive purely on one element and one element alone, according to the department, namely tax. And the moment the government moves to rationalize it, businesses will swiftly move to corner the gains against all other moving parts. Uh, Indeed, we've, as experience shows, all of us have been at the bar for fairly long, and we all understand that there are some black sheep, as there always will be in any sphere of life, who will want to profit here. But then what is required, to my mind, is a mechanism, and a legislative mechanism at that, not something which arbitrarily is decided by the NAA, or what the executive puts in by way of rules to counter such rogue elements. And you cannot, on the basis of exceptions, on the basis of fact that you have some people who actually want to take advantage of the system, you cannot, in a way, abort the entire system per se, to my mind. And this is something which, we hear all the time. So I don't think I need to labor on it too much. So to my mind, it is on this very critical arena that the law on anti-profiteering fails completely, and it falls short on this particular area. And as I move forward, you will shortly see that the NAA has been deciding cases based purely on its own perception of what profiteering means, and not on any tested mechanism. And I must say at this juncture that if you look at the law as it stands, there is a provision on anti-profiteering, 171, as we all know. There are rules which have been framed, but there is a complete lack of a mechanism on how the profiteering element, if at all, is to be decided. And that is something which actually stands in stark contrast to what the international experience has been. It is not as if that anti-profiteering is a new law and is a law only available in India. It's a law which we have picked up from various other countries. But when we picked up this law from the various other countries, we forgot that, those countries did far better and far more before the anti-profiteering law was actually brought in. Now, what is the international experience on this? So the internationally, India actually looked at the various laws already in play. They looked at, the law in Australia, Malaysia, Canada, New Zealand, and these are some of the countries where similar provision of profiteering were put in place. Now, India has drawn inspiration from the mechanism that Malaysia and Australia adopted as part of their framework. Now, what is the methodology which was adopted in Australia and Malaysia is that they fundamentally followed what is understood as the net dollar profit rule. That is, they determined the net dollar profit percentage on either an individual product or a class of product prior to introduction of GST, and then they applied the same percentage to post GST on the cost base of the supplier. What they did by undertaking this exercise was that they effectively dealt with all arguments of non-consideration of other aspects that could have impacted cost of supply, since the net dollar profit percentage, as we understand, inherently takes care of all such elements that could impact the cost of goods. So when you apply that to the base cost, and we understand, once you have the profit percentage, you are only extrapolating that profit percentage to the base cost of the supplier. What you're effectively doing is that you're negating all other arguments on what else could have impacted the businesses. There were monitoring authorities which were put in place to monitor profiteering, and this was done by the Ministry of Consumer Affairs in Malaysia. And in Australia, the Australian Competition and Consumer Commission did this exercise. And before they implemented GST, Both these authorities were entrusted with the task to frame guidelines for what constituted price exploitation. They conducted surveys to analyze the effect of price increase and its correlation to inflation. And they consulted businesses to understand reasons for price changes, and which is very important because price does not change purely on account of a tax rate, either going up or coming down, or a higher tax credit being made available. There are many, many reasons for which a price change can happen. Now, resultantly, what happened that these authorities had adequate data on the basis of which, when the law of profiteering was brought in, they could deal with these matters. And if you were to go by the media reports, what you will notice is that in Australia, of the 7,000 cases which were investigated, and this is telling, of the 7,000 cases which were investigated, only in 14 cases penal action was taken. If you were to compare that against what is happening in India, you will find, and I have some data on it, because largely there are three sectors which are affected, and I am dealing with those three sectors, namely the restaurant services, real estate, and FMCG sector. These are the sectors which are largely been affected. You'll find that in almost every single case where they have alleged profiteering, all of them have been upheld. Profiteering has been upheld by the NAA. So the experience, therefore, in India, as I am about to tell you, is not that great. So if you look at the Australian experience, and even for that matter, Malaysian experience, so here you have two countries, one which we consider possibly as a developed nation, second which we will consider akin maybe to ourselves, which is a country which is possibly developing. In Malaysia, again, there have been 640 cases which were investigated in the very first month of the GST regime, but hardly any cases really penal action were taken. So the experience of both these countries vis-a-vis India is entirely different. What is the legislative framework, therefore, in our country? We have Section 171 of the Central Goods and Services Tax Act, which mandates that any reduction in rate of tax or any supply of goods or services or a benefit of input tax credit is required to be passed on to the recipient by way of commensurate reduction in price. Now, to me, the key expression here is commensurate reduction in price. They do not use the term equivalent reduction in price. And to me, commensurate reduction in price is not equal to equivalent reduction in price. And the legislature, we all understand, is conscious when it is drafting the law that it did not choose to use the expression equivalent reduction in price, but rather chose to say commensurate reduction in price. When they chose the terms and the key expression, commensurate reduction in price, the legislature was conscious and it was aware that the price of goods is impacted by many, many factors and not the rate of tax alone or by the fact that there will be a higher input tax credit. Therefore, the use of the term commensurate makes it clear to me that the intent was to take overall facts and circumstances into consideration and therefore take a holistic view rather than pick and choose between the higher tax rate or merely the credit. Now, what are the three broad scenarios, as I understand it, wherein companies can resort to profiteering? And these are, as I said, the broad scenarios which, according to me, and there could be others as well, but these to me are the broad scenarios where companies can resort to profiteering and NAA needs to take corrective action. One is that it can happen on account of a benefit of enhanced ITC. Now, this first scenario can arise in cases of accrual of additional benefit of ITC to an assessee. Now, let me take an example, and a very simple example at that. Pre-GST regime in construction services, the service tax which was leviable was 4.5%, and there was a VAT of 1% in Maharashtra. And then under service tax, ITC was available on only the input services and capital goods and not on inputs And under VAT, as the builders were mostly under compensation scheme, ITC was restricted. Now I'm taking this one example, and there can be many others, within this, but I'm taking this one part of this example. Now, with the advent of GST, what happened was that the builders and developers are now entitled to avail ITC on goods and services used in the construction of a project, especially when the project has started before 1/4/2019. Thus, builders have enhanced ITC now available on account of introduction of GST. So this is one element which we'll have to bear in mind. Second is a reduction in the tax rate. Now, this scenario obviously arises in case of reduction of tax rate. And again, illustratively, in the FMCG sector, we've experienced that, consumer goods, initially, there was a tax rate which was 28%. They have been brought down to 18%. And thereafter, there have been, notified tax rates of even 12%. The third scenario is reduction in the rate of tax with denial of ITC. So you have, and this is where possibly the restaurant services come in, where the tax rates have been reduced from 18% to 5% without ITC. Now, let's come to the methodology which has been adopted by NAA, and let's see the infirmities which we see, which are involved. Now, the predominant sectors, as I mentioned, for which NAA rulings are pronounced are real estate, FMCG, and restaurant services. The NAA, while analyzing the issue of profiteering, to my mind, has failed to consider factors like rise in cost, business nuances, benefits already passed on to customers, etc., while coming to their conclusion on profiteering. Now, unlike the countries whose model India chose to follow, as I mentioned, the Indian authorities did not carry out any exercise of a market survey or a consultation to understand the reasons for price changes, likely effect of reduction in overall rate of availability of higher credit, nor did they frame any guidelines or what could constitute price exploitation. In short, the Indian authorities were woefully unprepared, and to my mind, again, while yes, it is a criticism, but to my mind, a criticism which is a valid criticism. And as again I said, I'm not going to say that there aren't any black sheep. There are numerous black sheep in the business community, but at the same time, I don't think we can stop criticizing what the authorities are doing, because certainly there has to be some improvement in that one arena, that which is the implementation of this tax and the interpretation per se. Now, therefore, in short, to my mind, the Indian authorities have been caught napping. And in fact, I can dare say that even after almost 3 years of the law having been brought in, there are no guidelines which are available on how the effect of tax reduction or the higher credit availability is to be accounted for by the businesses, so as to ensure that the ultimate consumer gets benefit. Because if that is your idea, please have guidelines which can be uniformly followed by all, not just the assessee, but the authorities and maybe the courts, who finally will give an interpretation to whatever is there. But at least there will be some sort of an uniformity, because once you have laid the guidelines. In fact, to me, it seems clear that, like in almost all other areas of tax laws that we've been dealing with in all these years, this has been kept delightfully vague, such that the assessees are always at the mercy of the authorities. And I understand it is possibly a criticism, maybe a little too harsh, but so be it, because that is what it seems to be. Because if 3 years have passed and if you've not improved the system, then clearly there is a lot to be said. Now, let me take the sector-specific infirmities, and I will not, there are many decisions. I will not want to go into each and every decision, but rather pick up the sector-specific infirmities so that people can understand, what sort of issues that I have personally witnessed in the matters that I have done. Now, in the real estate sector, as I mentioned, profiteering has been alleged to have arisen on account of an enhanced ITC available to the builders. The NAA methodology to compute profiteering in this sector, to my mind, suffers from numerous infirmities, which I have analyzed in a small table if we were to show the table, Pooja, if you can put up, yes, thank you. Now, what the NAA has essentially done is that it has compared the ITC available pre-GST with ITC available post-GST, which to my mind is a completely incorrect methodology. What they should have done instead, and I'll explain why, what they should have done instead is to compute the benefit of enhanced ITC, or what they should have done to compute the benefit of enhanced ITC is to consider the ITC that was not available in the pre-GST regime but is now eligible under the GST regime. Now, illustratively, as you would see, a case pre-GST. Let's take the base cost of the product, excluding tax as rupees 100. Now, the estimated all taxes which are leviable would amount to a 15% on the base cost, which is 100 rupees. The credit available at that point in time, and which obviously led to the cascading effect, and which obviously led to a cost built up in the books of the supplier, was that the credit available was only 6 rupees. Therefore, the cost to the builder was that 9 rupee which was the credit which was not available to him, got added to his cost. Now look at the scenario post the introduction of GST. Post GST, what you have available is a base cost of 100, a tax rate of 22. What is the input tax credit now available? The entirety of that is available to you. Therefore, you have a 22 rupee as your credit which is available. Therefore, the net cost under the GST regime is rupees 100. Okay. Now, comparing ITC available pre and post GST and arriving at a conclusion that the total benefit to the builder is 22 minus 6. Therefore, 16 rupees to my mind is entirely incorrect. This does not account for the fact that in the first instance, the rate of tax at rupees 22 today under the GST regime is higher than before, and secondly, this is entirely creditable. As against that, under the pre-GST scenario, while the tax rate was lower, at the same time the credit available was limited, on account of which there was a cost of rupees 9 which was being borne by the builder, which is actually the enhanced credit now available in the builder's hand. This is not what the NAA is doing. NAA is deducting 6 from 22. 6 was the earlier credit available. Now the credit available is 22. 22 minus 6 is 16 rupees, and therefore that is the enhanced credit according to the authorities which is available in the hands of the builder. And to that extent, there is profiteering, and therefore the builders ought to pass on that much of a benefit to their customers. We must understand that ITC is a balance sheet term. It does not form part of the profit and loss. To arrive at profiteering, one should be able to establish that an amount has been recovered from the customer. In this illustration that I have given, ITC available under pre and post GST, that is 6 and 22, was never recovered from the customer, as these are accounted in the balance sheet and not under the profit and loss. And the accountants amongst us will understand this very, very clearly. Therefore, what is recovered is 9 rupee, and that 9 rupee alone can be said to be the amount which has been profiteered. And again, there have been instances, and I had this matter before the Delhi High Court, where my client had actually passed on the benefit in the well, I wouldn't call it a GAB, because to me he had rightly passed it on as a discount. And when saying that I'm giving you a discount, he said that it was on account of the enhanced credit which is available. The NA, the DGAP actually gives a report where they say that, oh, this is a discount, and discount does not mean that that the credit has been passed on. NA upholds that, and they come to a finding that a discount is something which is given as a regular trade practice and cannot be considered as passing of the benefit on account of anti-profiteering. It completely beats logic, and it completely beats me how, when a person has said that I'm giving you a discount on account of the fact that there has been an enhancement of tax credit, how can the authorities treat it any other way? Uh, that apart, the other ways in which the NAA has denied or the NAA has failed to consider various other elements which actually impact this one particular element is that, when arriving at the cost, they should have considered, various issues such as the stage of construction in which a building was, the class or type of vendors of the builders, the ratio of the material and labor in the construction cost, because that would in the pre and the post GST scenario, that would have had an impact. None of this is being considered, and when you tell them all of this, they say nothing doing. This is what is according to us, is the calculation. uh, Commensurate means equivalent, and you should therefore pass on the equivalent benefit. Then, the fact that there is an escalation in the construction cost, there is a change in the rate of tax on procurement in pre-GST and post-GST regime. The fact that there is a reversal of ITC, which happens on maybe a much later stage. That is at the stage when the OC is granted, or on account of cancellation of flats. What would happen at that point in time? So none of this is given any consideration by the authorities. Let us quickly move on to the next sector, as I mentioned, which is the FMCG sector. For this sector, the majority of the orders passed by the NAA pertains to those cases where the tax rate reductions have happened in the post GST era, because you are aware that, as I mentioned, that the rate initially was 28% and then brought down to 18%. Now, NAA has predominantly alleged that the companies have committed profiteering, and how they did that was that they compared the base price of the product pre-GST. So the base price of the product pre-GST tax reduction with the base price of the product post-rate reduction. Now, the infirmity, to my mind, which are associated with this methodology are numerous. Again, just as an example, consider the fact that there are various kinds of, assessees. Now, what they have failed to appreciate that, one of the kind of registrations that you can have is an assessee who enjoyed pre-GST and post-GST era. So let's take an illustration again. Illustratively, there could be a company which could have availed SSI exemption and were paying VAT at 12.5% and was paying no excise duty at all on certain products. However, under GST, the initial rate of tax for the product was 28%, which was later reduced to 18%. And again, I'm not going to further rate reductions. For ease, I'm only taking the reduction of 28 to 18. Now, when the transition to GST happened, initially when the tax rate was reduced from 28 to 18%, many companies actually did not increase the price of their final product, but rather chose to absorb the increased burden of tax, that is from 12.5% to 28%. Then, when the rate of tax was later reduced from 28 to 18%, these companies, for obvious reasons, did not bring the prices of their final product down. Now, in these cases, what the NAA has done is that the companies, they have held, and again, this is from personal experience of certain clients, the NAA has held that the company's decision not to increase the MRP during the transition from GST, from pre-GST to GST, namely from 12.5% to 28%, when the prices did not change, that they've said is a business call. Why does the authorities have to be bothered about that at all? But when it came to a later reduction in tax rate from 28 to 18%, keeping the MRP unchanged, they said that this was an act of profiteering. It beats me. Here is a businessman who does not increase his prices when the tax rate has substantially gone up. But when at the same time there is a reduction in 28 to 18%, and he does not bring his prices down, in one instance you will say that that's a business call that you make, and because that suits your pocket, you will say that that is a case of a business decision, a completely business call. But when it comes to a reduction, you will not give it the same objective criteria. You will not adopt the same objective criteria, and it beats me. Again, why would they do something of this kind? Then again, the nature of the business, NAA completely wants to not look at the nature of the business that people are engaged in. We are well aware of various orders where NAA has held retailers to be engaged in profiteering. We all again understand that retailers generally operate on a net realization basis and are entitled to their margin by working backward on the MRP. They do not fix the MRP, which is obviously the prerogative of the brand owner. Therefore, reduction in price is not in their hands. Also, discounts offered by retailers to pass on benefit in many instances have been ignored by the NAA. Then again, to arrive at the base price, the supply chain model which has been followed for each product, which ought to have been ascertained, such as whether it was a principal agent model, was it a stockist model, or a stock and sale, or a distribution model. None of this has been considered. Location of sale, whether it was at a mall or it happens at a standalone retail store, has not been looked at. What were the terms of sale? Was it cash, credit? Was it against card? Was it against deferred payment? Again, something which has not been seen. Whether the sale of goods is from the pre-GST stock or otherwise, which should have been considered, has not been considered. The fact that there is an increase in operational cost has been ignored. Other practical challenges that businesses face to change tax rate, the MRP overnight. You can change the tax rate overnight, but can a businessman change his MRP over time? It may not be possible because he may have inventory lying in the factory. He may have inventory in the distribution center. It could be in transit. Can he suddenly, change it overnight? May not be, that easy to do as you may be able to do in case of a tax rate. None of this has been considered. Quickly moving on to the next, service, which and next example, which I'm, wanting to speak on, is on restaurant services. With effect from 15th of November 2017, GST on restaurant services was reduced from 18% to 5%, which is obviously without the benefit of ITC. It was alleged that companies resorted to profiteering as the sale price of the food items sold remained unchanged. The methodologies adopted by NAA to compute profiteering is thus: what they did, and you will see that on your screens, to arrive at the ratio of ITC block post rate reduction, the DGAP considered ITC as a percentage of the total outward taxable turnover for the period prior to 15/11/2017, and it was agreed that this base price could increase only to the extent of such ITC denial. DGAP then compared the base price pre and post 15/11/2017 and concluded that the companies have increased base price much more than what was required to offset the denial of credit, and therefore commensurate benefit of reduction in tax rate has not been passed on to the customers. Now, again, what the NAA has failed to consider are the following, to my mind, following crucial aspects. There are expenses which are incurred at the year end. So considering ITC for a specific period will not give you a true picture. So you can't have, you can't say pre and post, compare both of them and say that, this is what it is. At what level price change should be reflected, whether it should be entity level, it should be, various state, location level, product level, product category level, excuse me, or various SKU levels. Each will possibly show a different result in pricing. None of this is taken into account, and you go to the NA or the DGAP, none of them are willing to, take anything into account. What about increase in royalty amounts? What about increase in cost of raw material? What about the fact that different products have different life cycles? What about the fact that, there is increased payment to various service providers possible? What about, and the most important, therefore, the aspect, competition in pricing and market condition. None of them the DGAP or the NAA is willing to consider. Now, let me talk about, again, certain orders of NAA and imposition of penalty. What I've done is I've tried to, instead of speaking of different orders, because, that is for all of you to see. I'm sure all of you've seen various NAA orders, and, the fact that they've gone to the various high courts is something which is well known to the group. I will therefore not dwell on particular orders. Let me therefore, try and generalize it. May not be the right generalization, but on average, as I see these, this seems to be the manner in which NA has dealt with various orders, both on holding profit on profiteering and also on imposition of penalty. Now, in most of the orders, besides holding that the supplier is guilty of profiteering, NA has also directed a DGAP to investigate other goods and services provided by the supplier. So I've already said, dealt with those three examples of how NA has dealt with various, various industries and what sort of orders they have passed. And they are no different when it comes to any other industry, because every industry, they are following the same methodology. They are not giving heed or paying heed to any of the submissions which are being made. But at the same time, what is interesting is that they are asking for investigation of other goods and services provided by the suppliers, which are not the subject matter of initial investigation. Now, these, as I understand, are roving investigations, qua the same GSTI number across business verticals in different business locations involving different periods, and thereby they are expanding the scope of investigation multifold. Various assessees approached jurisdictional high courts against such orders on the ground that NA is not empowered to direct any investigation in the absence of a complaint or a report submitted by DGAP. One decision of the High Court that I must mention here is the decision of Rekit Benkaiser of the Honorable Delhi High Court, which was passed on 19th of July 2019, that held that a company is not liable to furnish any information regarding product other than those covered by DGAP's investigation report. And absolutely right order, because the NA, under the provisions, whether under the rules or under the main provision, has no authority really to go into a roving inquiry and to ask for investigations into various other things merely on account of a suspicion. But they did exactly that, and the High Court rightly held what it held. Now, to overcome this, and this is where to my mind the problem really lies. To overcome this, the Ministry of Finance immediately comes up with a notification. And sorry, when I say immediately, this notification came in 2019, in June of 2019. They inserted a sub-rule 5 to Rule 133, thereby empowering the NA to cause investigation or inquiry qua products other than those covered in the investigation report. Now, this is unfettered power which is vested in NA to broaden the scope of investigation, and to my mind, it is completely arbitrary. One may ask, what really is the rationale for NA to seek investigation into other goods and services? Does it, does and can it have any specific intelligence, or did it rely solely on its suspicion and what we understand as a gut feel? Because, we understand in this country that there is a complete mistrust of the assessees. So is it the mistrust of the assessee that is, and therefore your gut feel that if there is an allegation of profiteering in one product, there has to be a anti-profiteering or a profiteering in other products? Has it received any actual complaints vis-a-vis the non-offending goods? If not, then where does its locus really stem from? How can a rule give the power to the NA what possibly even the main provision does not? And to my mind, the main provision does not say anything of this kind. It is completely lacking on many aspects, and this is one of the aspects that it completely lacks. What is the sort of power that NA enjoys? It completely lacks. Therefore, how can a rule overcome or add anything to a provision which really does not have any such power given to the NA? Is this, therefore, a case of exercise of powers on whims and fancies? To my mind, absolutely. I would absolutely say that it is a case of exercise of power on a whim and a fancy. Now, what else would one say falls within this realm? Now, these are questions, I don't really have an answer to. I may believe rightly or wrongly and again on case to case basis, I may believe that one is right and the other is wrong. But why I'm bringing this to the knowledge of this esteemed audiences, because I want to leave food for thought, because there'll be enough and more instances which will come to the notice of people, and I think it should raise it should help raise red flags so that people can take, appropriate action against orders that NAA passes. Now, again, let me, quickly jump on to the penalty aspect of it. We all know that, by virtue of a newly inserted section, which is section 171, it's a subsection, namely 3A. NAA has been passing orders proposing commencement of proceeding for imposition of penalty for alleged profiteering. Pursuant to an order of profiteering, a show cause notice is being separately issued by the NAA, calling upon the assessee to show cause as to why penalty ought not to be imposed. And this provision is invoked and is being read with Rule 133, Subrule 3, Clause D of the rules. Now, very quickly, prior to the introduction of 171(3)A, and there are those orders which are floating, and actions have been taken by various people against this as well. There was again no provision within the GST Act prior to the introduction of subsection 3A, which specifically provided for penalties for profiteering. What NAA was doing was that it was relying upon section 122 of CGST and was reading that along with 133(3)D of the rules to impose penalties. Needless to state that such orders were grossly illegal because section 122 has no application in a case relating to profiteering at all. Separately, 133(3)D alone could not have been applied to impose penalties for the infraction of profiteering, since, as we all understand again, subordinate legislation draws its powers from the statute under which it has been made and cannot go beyond it. And inasmuch as the CGST Act prior to 1/1/2020, which is the date on which subsection 3A has been introduced, did not contain any provision for imposition of penalty on alleged cases of profiteering, the NAA could at best, have invoked the provisions of the residuary section, which is section 125, and imposed a penalty merely, to my mind, to an extent of 25,000. And therefore, clearly, all such orders passed by NAA to impose penalty to the beyond that section and beyond that provision, beyond that amount, are all arbitrary and illegal. We all understand again, when it comes to the challenges to the orders of the NAA, from the provisions of 107, one of the CGST Act, NAA has been kept out of the purview of adjudicating authority. So there is, no provision, an appeal provision available from an order of the NAA. That apart, today also there is no tribunal which, or an appellate authority for that matter, who can consider a challenge to such an order. Therefore, various writ petitions have been filed in various high courts. The key grounds which have been taken in these challenges are that, section 171 in itself is ultra vires, article 14, 19, 1G, article 246A of the Constitution of India. I must, say that I find it a very, very difficult challenge to surmount on these grounds of either article 14, 19, or, but various grounds have been taken. I find that it is going to be very difficult. This is not going to be an easy task, and for very many reasons. And we can, but today is not the day to discuss that, because we can discuss it in a very different forum on a different day and maybe on one-on-one basis. But that is something which has been taken. And my personal belief is it is going to be very, very difficult to surmount such a challenge, or rather mount such a challenge. Two, the submission which has been made is that Rule 126, which grants power to NAA to frame methodology, suffers from excessive sub-delegation. And this, to my mind, is something which is worth the challenge, because there is nothing otherwise available either in the provision or the rules to tell us or to guide and assess you on what are the modalities and what is the method to arrive at a so-called profiteering. And therefore, I started off by saying that no guidelines have been framed. Three, the composition of NAA is unconstitutional. Again, I find that this is a good challenge to my mind. No judicial member, again, the termination by central government, and no appellate remedy has been prescribed. So this, to my mind, is again good. then absent a machinery provision for determining profiteering, the demand itself ought to fail. Again, good, but I think, the high courts are in the mood of saying that that would mean that I would admit possibly your petition, but in the meantime, if a provision is brought in, obviously, they will ultimately say that this is, to my mind, what high courts will also say, that this is clarificatory and should apply to all. How it will, how this machinery provision will be framed in itself will have to be seen, and many other challenges can be mounted, but we'll have to see how they pan out. Commensurate, the fact that commensurate benefit ought to be passed on in any manner. The mode and the nomenclature is again irrelevant. That is something that is a challenge again, which to my mind is a good challenge. Suo moto investigations cannot be directed by NAA. I've already dealt with it. Again, to my mind, something which can be done, and then penalty imposed prior to 1/1/2020 is without authority of law. Again, that is something to my mind which is good. I would want to conclude very very quickly. I know I'm possibly overshooting time, and there could be questions. To my mind, again, in the NA, in subway systems, has observed that the welfare of the consumer who are voiceless and in the unorganized and are scattered in is the soul of anti-profiteering provision. To me, one of the questions that arises is that is positioning of such consumer welfare provision under a taxing statute, that too in the form of recovery and penal liability, at all valid. The NAA has been consistently emphasizing that any reduction in rate of tax is a notional sacrifice by the revenue of by the government, the benefit of which necessarily needs to be passed on to the final consumer. Let us consider this a little differently. Under the constitutional scheme of things, this assertion to me does not seem very well articulated, because when a tax rate is reduced from, let's say, 10% to 5% by the government, there is a new levy which is 5% by the government, and the government is then authorized to collect only that amount as tax. The government has no right on any amount that is above the prescribed rate of tax, and as at the same time is not, this is not authorized by law. Anything over and above was never authorized by law. The constitutional scheme of things, if you were to see, does not envisage any notional tax or a notional sacrifice of such notional tax. Therefore, to state that every tax policy is aimed at reducing the prices for the final consumer, that too without taking into account the interest of the business, to my mind is absolutely foolhardy. Are you going to say that businesses ought not to benefit the reduction in tax? And if that is so, every single time that a tax rate was brought down by way of a notification, or is even today done in a customs sphere, why is the government not saying that every bit of benefit ought to be passed on to the final customer? They don't say that. There is a rate reduction which happens, and they are not talking about passing out that benefit to the final customer. So this is again something to which to my mind is questionable. And in any event, deciding the pricing of goods, services actually goes beyond the legislative competence of Article 246 A and 265 of the Constitution of India. This, to my mind, should be the thrust of a constitutional challenge and not anything else. Because how can you ask, or how can you really ask a business to follow a particular pricing mechanism? That is something that needs to be taken into account, and that is something we need to apply our mind to. Also, one needs to ask a question of the legislature. Should the tax collector be asked to adjudicate what is essentially possibly a consumer dispute? Now, assuming for a moment that 171 is constitutionally valid, it is, to my mind, settled position in law that in the absence of proper machinery provision, the entire scheme of statute by which a change is sought to be created ought to fail. And in case of anti-profiteering, no provision of GST law prescribes, as I said, any mechanism. And I know I'm repeating myself, but it is worth repeating that there is today no mechanism or methodology for determining anti-profiteering measure, and it is hurting the industry to no end. And in the absence of a determining mechanism, the entire investigation which is undertaken either by the DGAP or thereafter the adjudication which happens by the NAA appears to be unconstitutional and without the authority of law. I believe that codifying methodology and appointing right authority could have been the key to effectively put profiteering measure in place and lessen the burden on the high courts, where several writ petitions are today pending. But, you know, as I said, our lawmakers, I don't think ahead, you know, and the international experience that I spoke of is out there for all to see. We have a developing nation, we have a developed nation, to my mind, who have done a lot of hard work before the law was brought in, who brought in data before, you know, they brought in the law, and who analyzed that data, and that is not available, sadly, to our authorities. And even in the last 3 years, there has been complete non-application of mine, both with the authorities and the lawmaker. I don't think, and we all understand, you know, in India, the law-making process, barring, I must say, and that we've seen in the arbitration sphere happening quite frequently. It happened after 20 years, but nonetheless, it happened quite frequently. But otherwise, the lawmaking in India, you know, happens at a snail space, not even elephant space, and that is always to the detriment of the assessee. We, yes, as lawyers, as consultants, all benefit, but it is always at the detriment of the assessee. With that, I think, you know, I have exceeded my time limit, but thank you all for being such a patient, you know, such patient listeners. And thank you for, you know, allowing me this time.
Thank you, Naresh bhai. It has been a wonderful exposition and a very fast and comprehensive presentation which you made. If there are any questions, you can put it on the chat window, and I'll unmute the respective participant, or maybe I think your presentation has been so clear that there are not many questions. I think Mr. Krishnan has some question to ask.
Yes.
I'll unmute Mr. Krishnan. You can ask the question. I unmuted you, sir.
Naresh.
Yes.
Yeah. Hi, how are you? See, in this anti-profiteering, the philosophy is pre-GST and post-GST era. And in all legislation across the world, there is a sunset clause of 2 years.
Yes.
Since up to 2 years, that is transaction up to 30th June 2019 in our case.
Yes.
But that is the philosophy of this anti-profiteering. When all the taxes are subsumed in a new method of taxation, pre and post GSTs, if they profiteer, that only should be within the jurisdiction of this section 171. So everyone should have had a sunset clause.
Absolutely. Absolutely.
Definitely doing that in 2019, 2020 or 2025, that is not a concept of anti-profiteering. So whether on this point, there can be a challenge or representation, that's a sunset clause.
Yeah, so, you know, to my mind, that will be held to be a legislative measure. You know, that is not something for the courts to really say whether there ought to be a sunset clause or not. That surely will be left to the legislature to decide. And I don't think, you know, a constitutional challenge will be mountable on that basis. But I agree with you. You know, I completely agree with you that a sunset clause ought to have been there. You know, apart from whatever else I spoke, sunset clause ought to have been there. This is not something which is to be continued ad nauseum.
Especially the object of the legislation, if it is looked into.
Correct.
171. Correct. And world across, they have a sunset clause of 2 years.
Absolutely. Absolutely.
Thank you.
Thanks.
I don't think there are many more questions. So I'll hand over to Lodha sir for his concluding remarks, please.
Thank you very much, Naresh. Excellent exposition, very lucid, very powerful, and very passionately argued for the industry. My compliments for that.
Thank you so much, sir.
Now, since you have argued so passionately, may I put across a small viewpoint on the part of the revenue? And I think there is a logic for that. Plain reading of section 171, you can't really find fault with. All that they are saying is, if there is any reduction in rate of tax on any supply of goods, or services or the benefit of input tax credit, that shall be passed on to the recipient by way of commensurate reduction in prices. What they are saying is, if earlier we were charging 28 and now we are charging 18, we have taken a sacrifice of 10. We expect you to pass on this sacrifice of 10. We will keep your profit margin intact. That is the short philosophy which they are advocating in 171. So on the face of it, you can't really find fault with it.
Sir, and therefore, to my mind, as I said, constitutional challenge to say that 177 is bad in law or against the philosophy of Article 246A or, take it to any other taxing provision, to my mind, it will fail. I don't think, sir, that is something which will hold good. And therefore, I said, sir, to my mind, it's the implementation which is wrong. The fact that there is a methodology which is lacking, the fact that, the NAA has been given arbitrary powers because there is no methodology provided, whether in the Act or the rules. And therefore, the authorities have been doing what they want, really.
No, I think the comment which you made about the profit and profiteering should be distinguished is a very, very valid and perceptive comment. I completely agree with you. And that is how it should be really looked at.
Yes.
That profit, and I may make a lot of profit, but indulge in no profiteering. And I may have made no profit. I may have run into a loss. And yet I could have profiteered.
True, sir. True.
Within the meaning of 171.
I agree with you. And therefore I said, sir,
you're right, absolutely.
Every single product and every single supply line will have to be therefore seen to arrive at this question of profiteering rather than, say profit.
Correct. My only little submission was that while it's very good to train all the lawyers to challenge the provision, maybe someday you may like to also mention or talk about how to work this provision.
Yes, sir. Certainly.
How to work around 171 and what they should do. Challenging is one part, filing petitions in the High Court is another part. While at the same time, till it is set aside, people will have to work through 171.
True, sir. True.
So what should be the best method where remaining within the framework, they could sort of take care of it?
Absolutely, sir.
For example, nobody has said, in fact, some of the orders of NAA would allow the cost increases.
True.
But if you are able to demonstrate that your cost has gone up from 10 to 15, they are willing to give you that money. But supposing, for example, taking your example, on 14th of November, you were making, say, 10% of the profit on certain goods. On 15th November, they brought down from 28 to 18. Now, on 18th November, your prices have not come down, or maybe 1 month later, it has not come down. You will have to justify. You are entitled for your cost increase. But merely saying that, look, it is not on and you are not considering it, he said, fine, we'll consider it. Show it to me. Which cost elements have gone up? So if you are right in saying costing will have to be gone into, it is a different question to raise whether or not you can go into the question under this law. That's a different matter altogether. Assuming I can go into, then I have the costing. There are 11 elements of costing. I find 10 remaining constant, only the tax change has occurred. Sir, why is it not reflected in your prices? That answer the industry will have to be ready with.
True. True.
So I think this part, maybe on some other, it's a vast subject. You've dealt it beautifully. Thank you so much for your time.
Thank you so much, sir.
And thank you so much for your articulation and very well presented. Thank you.
Thank you, sir. Thank you. And thank you all.
Thank you. Thank you, Mr. Krishnan.